Hey everyone, welcome back to Corporate Decoder, the place where we decode the financial mysteries that shape our world. And today we're diving into Columbus Acquisition Corp's latest quarterly report, a document that is both a financial snapshot and a peek into a company that is essentially still searching for its identity. The big story here is that this company is still in its early stages, focused on finding a business to combine with. Think of it like a SPAC, a special purpose acquisition company, and they've just shared their financial health for the period ending the 30th of September 2025. Let's jump right into the numbers and what a difference a few months can make. As of the 30th of September 2025, Columbus Acquisition Corp had about $638,000 in cash. But when we look at their total assets, it is a much higher number, a whopping $62 million. Where is that coming from? Most of it, over $61 million. Is sitting in a demand deposit within a trust account. This is typical for these types of companies. They raise a lot of money in an IPO, put most of it in a safe place like a trust account, and then go looking for a company to buy. This line item here, ordinary shares subject to possible redemption, is really important. It is showing over $61 million representing shares that could be redeemed by shareholders. This is a key feature of these SPACs. Shareholders often have the option to get their money back if they don't like the proposed business combination. Now, looking at the shareholders' equity, we see a small positive number, just under $588,000. This means that even with all the money raised, when you factor in their liabilities, they're just barely holding onto a positive equity position. It's a tightrope walk at this stage. When we look at their operations, it is no surprise there is no revenue. They haven't bought a business yet. The numbers here are mostly about expenses and a significant amount of interest income. For the 3 months ending the 30th of September 2025, they reported a profit of almost $498,000. But don't get too excited. This is almost entirely due to interest earned on the money sitting in that trust account. Their actual operating expenses, the general and administrative costs, were around $132,000. Looking at the bigger picture for the 9 months ending the 30th of September 2025, the net income is over $1.1 million. Again, this is driven by interest income, which was a little over $1.6 million. Their operating expenses for this period were significantly higher, around $538,000. This highlights that their profit is really just the return on the money they've raised, not from running a business. This section shows how the equity has changed over time. It is a bit complex, but you can see the impact of issuing new shares, the accretion of carrying value to redemption value, which essentially means adjusting the value of those redeemable shares, and the net income. The numbers here reflect the issuance of private placement units and other share-related activities, all part of building the company's capital structure before a business combination. The cash flow statement tells us where the money is coming from and going. For the 9 months ending the 30th of September 2025, they used about $428,000 in operating activities. This is mostly their general and administrative expenses. They also used a massive $60 million in investing activities, which was primarily depositing money into that trust account. The good news is they brought in over $61 million through financing activities, mainly from the IPO and private placements. Scroll note 1 organization, business operation, and going concern consideration. Scroll now, let's touch on the foundational aspects. This is a blank check company formed in the Cayman Islands back in January of 2024. Its main goal is to merge with or acquire another business. They are upfront about potentially having strong ties to China and how that might affect their search for a business partner. They don't have a specific target yet, and their ability to operate is tied to successfully raising funds and finding that business combination. They have a deadline, January 2026, to complete this. Otherwise, they'll have to liquidate. This section is crucial. It directly addresses the company's ability to continue operating. As of the 30th of September 2025, they have around $638,000 in cash and a working capital surplus. However, they acknowledge the significant costs of being a public company and pursuing a business combination. The report explicitly states that their mandatory liquidation if they don't find a business by their deadline raises substantial doubt about their ability to continue as a going concern. Management's plan to seek new financing to complete a business combination. It's a high-stakes gamble. Scroll note 2 significant accounting policies. Scroll this section talks about how they prepare their financial statements. They're following us generally accepted accounting principles, and importantly, they're an emerging growth company. This means they get some breaks on reporting rules, which is common for newer, smaller companies. They can also adopt new accounting standards later than other companies, which might make comparing their financials to others a bit tricky. This is where they explain how they account for those shares that shareholders can redeem. They classify these as temporary equity, meaning they are not part of the permanent shareholders' equity until certain conditions are met or they are redeemed. The carrying value is adjusted to reflect the redemption value, and this is treated like a dividend. It is a way to account for the potential outflow of cash. Scroll Note 3 Initial Public Offering. Scroll, this is where the IPO details are laid out. On the 24th of January 2025, they sold 6 million units at $10 each for $60 million. Each unit came with a share and a right to get a fraction of a share later. They also mention an over-allotment option for underwriters, which expired unexercised. This is pretty standard for IPOs. Simultaneously with the IPO, they sold over 234,000 units to their sponsor for about $2.3 million. These are essentially the same as the public units, but with some restrictions, particularly on when they can be sold. This is a crucial part for understanding the internal dealings. The company's sponsor, Hercules Capital Management via Corp, is heavily involved. They initially bought founder shares for a very small amount. There was also a forfeiture of some founder shares because the underwriters did not exercise their full option. We also see details about shares transferred to independent directors for their service, and a share purchase option granted to a director, which represents a form of stock-based compensation. Scroll promissory note related party. Scroll. There was a promissory note with the sponsor, a loan for IPO expenses. It was repaid upon the IPO closing. This shows how related parties can inject capital into the company to get it off the ground. The company pays its sponsor $10,000 per month for office space and administrative support. This is a normal operational expense for a company in this stage, ensuring they have the infrastructure to function. Scroll Note 6 Commitments and Contingencies. Scroll, this covers various agreements. They have registration rights for certain shareholders and a detail about the underwriter's agreement. The underwriter received a commission and representative shares, which are also subject to certain lock-up periods and voting agreements. Scroll Note 7 Shareholders' Equity. Scroll here. They detail the different classes of shares. Preferred shares are authorized but none are issued. Ordinary shares are the main focus, with details on founder shares and how the total number of outstanding shares has changed, reflecting the IPO and subsequent events like the forfeiture of founder shares. The rights are also explained here, detailing their conversion into ordinary shares upon a business combination. Scrollatum 2. Management's discussion and analysis of financial condition and results of operations. Scroll, this section is management's narrative about the company's situation. They acknowledge being a blank check company focused on finding a business. They reiterate the IPO details and the funds placed in the trust account. They expect increased expenses as a public company and for their search efforts. They confirm no direct operating revenues yet, with income mainly from interest on the trust account. They expect more expenses related to being public. The net income figures are broken down, emphasizing the interest income. This is where they discuss their ability to pay bills and fund operations. They have cash on hand and are using funds outside the trust account for their search. They anticipate needing more financing to complete a business combination, or if many shareholders redeem their shares. The report again highlights the potential need for additional financing and the risk of not completing a business combination by January 2026, which would lead to liquidation. Scrollatum 3. Quantitative and qualitative disclosures about market risk of Scroll. As a smaller reporting company, they are not required to provide detailed market risk disclosures. This covers their internal controls for financial reporting. They state that their disclosure controls and procedures were effective as of the 30th of September 2025. There were no significant changes in their internal controls during the quarter. Finally, the report is signed by the Chief Executive Officer and Chief Financial Officer, attesting to the accuracy of the information presented. Now let's step back and look at the bigger picture here. Columbus Acquisition Corp is in a very typical SPAC situation. They've raised a significant amount of money, most of which is parked in a trust account earning interest. Their income and profit are almost entirely derived from this interest, not from any actual business operations. This is expected for a company in this phase. Their primary focus is on execution, finding, and completing a business combination. The biggest strength is their access to capital, evidenced by the millions raised in their IPO and private placements and the substantial amount in the trust account. This gives them the runway to search for a target. However, the weaknesses are also quite apparent. The looming deadline of January 2026 for a business combination is a huge pressure point. If they don't find a suitable target and close a deal by then, they will have to liquidate. This uncertainty is a significant risk. The going concern statement in the report is a formal acknowledgement of this potential outcome. Furthermore, their significant ties to China could indeed present challenges in finding a business combination partner, especially if they're looking for a US-based target. The opportunity for investors who bought into this SPAC lies entirely in the quality of the business combination they eventually strike. If they find a strong growing company at a reasonable valuation, the SPAC structure can be beneficial for investors. But if they make a bad deal or fail to close one, investors could lose their initial investment. Looking at the core financials, the interest income is masking the operational costs. The general and administrative expenses, while not astronomical, are consistent and will continue to chip away at the capital not held in the trust. The critical factor for Columbus Acquisition Corp moving forward is their ability to identify and successfully negotiate a compelling business combination that is really the only game in town for them. Alright, that is our breakdown of Columbus Acquisition Corp's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into the corporate world. Don't forget to check out the Discord community linked in the description below. Thanks for watching, see you next time.